We've saved the best for last: credit risk, interest rate, financing, and Travis has promised he's brought Wells Fargo's checkbook up here. He's making loans. So Stan Gravemeyer is our moderator. Stan is the head of our real estate department at Dean Meade. Stan has his undergraduate degree from FSU and his law degree from the University of Florida. As I remind him, when it came money time, he's a Gator. And Stan will introduce the rest of his panel for our last presentation. Thank you.
Thank you, Michael. My fellow panelists are from the McGladrey firm, Clay Worden. Clay's involvement with agriculture runs deep. It says in his bio that he was raised on a ranch in Wyoming. He graduated from Flagler College, and he spent the last 20 years providing accounting and consulting services to agricultural clients. He specifically lists experience with citrus, cattle, row crops, grain, nurseries, tree farms, sugarcane, tobacco, and as well as aquaculture. As a leader of the agribusiness practice at McGladrey, he's responsible for the development and delivery of a lot of their customized tax planning techniques and accounting solutions. In addition, Clay is a director for the National Society of Accountants for Cooperatives and has conducted a number of seminars and webcasts. Is a recipient of the 40 Under 40 Award of the Orlando Business Journal, which is a big award in Central Florida, and was recognized as Volunteer of the Year by the Florida Small Business Development Center. Also on our panel is Travis Robbins. Travis is with Wells Fargo. He is their business banking manager for the Treasure Coast region down near Michael's office. And he leads the agriculture strategic initiative for Wells Fargo. Travis joined Wachovia, the predecessor, in Raleigh, North Carolina in 2003. He had previously spent 7 years with the John Deere Company as a credit analyst and held other positions as well. He may have sold some of you guys a tractor. Travis got his BA in business management from North Carolina State University and got his MBA from the University of North Carolina. Like me, you switched. Okay. Travis and his wife Mary Lou have 2 small children. Travis lives in Vero Beach. Our format today was to pose some questions to which they're kind of ready to answer in advance, and to move through those questions in a direct order. When we run out of our allotted time slot, we will stop, ask for questions from the audience, and will not hold you over just because we get a little long-winded. I promise that. We know that agriculture has not been spared from the credit crunch. And agriculture as an industry presents a lot of challenges. You get months and months of expenses before you get a payoff, and you get to bear the risk of loss during the meantime from casualty, weather, whatever. Presents a lot of cash flow challenges, and you'll see that that's recognized by both of these gentlemen because some of their questions are designed to go right to agricultural cash flow issues and how they can give some advice. Having said that, guys, how about the first question? Describe the current environment for financing.
All right. I'll start off with that one. I think it was one of our very first presenters speaking about labor issues said one of the tough parts of his role was, in dealing with agricultural producers, he didn't have any good news for them. And, where I sit on the financing side, I think it's a mixed bag, but it is an improving picture. There are some lenders out there that are still struggling. Generally, if you're doing business with them, you know who they are. But most of our larger lenders in our market, Wells Fargo, some of the other regional lenders who are new to Florida, as well as some of the community banks that have recapitalized, are sitting on a lot of capital or sitting on a lot of deposits and do have money to lend. That said, we also see a lot of our stronger borrowers and potential borrowers are reluctant to borrow. There's so much uncertainty in the world, both in agriculture and in the general economy and the regulatory environment, that people aren't willing to step out there and expand. And what that's caused for us is when there is a strong borrower who's looking to borrow money, the competition is as intense as ever. And that's to your advantage as the borrower. That said, our regulatory environment is much different. Our due diligence standards are higher. We're going to ask more questions. We're going to need more information. That's the reality of the environment that we're in today versus some of the mistakes we made in the past, and also our regulatory environment today. Cash flow is still our most important factor as a bank lender. Some lenders take more of an asset view. We start with cash flow. Some of the loan to value, some of the lack of equity that we saw in projects in past years, those things won't come back. They won't come back anytime soon. There is a more cautious standard today, and I think that's appropriate. I mean, we saw what the last few years have looked like with people taking on too much leverage, too much debt, and what that's done. But that said, we're here, we're in the business, and we find plenty of competition out there that's also willing to lend money.
Next question.
We're ready.
All right. You guys must have come up with this one. I understand cash is king, but doesn't my income statement provide all the cash flow data I need?
I think Travis talked about the net worth of many companies, and historically, probably over the last decade, those companies that have had a strong balance sheet and had significant net worth and showed some profits, maybe a positive trend in profits, could persuade their bankers into financing. And I think what I've seen lately, and when I say lately, I've helped several organizations. I've got a transaction right now, $138 million purchase that a company's working on. I've got several clients that are doing $30 to $50 million refinancing. I've got a transaction, a $50 million bond transaction. They're doing some refinancing, and several lines of credits from $5 to $25 million. And so my comments are kind of framed on that. And we had a discussion with the bank on the larger transaction I mentioned, and the first question the bank asked was, why don't you just pay cash for this? The bank knew they had significant net assets, and so it kind of shocked us that the bank's first posture, instead of wanting to provide a loan, they said, why don't you use your own reserves to do this transaction? And as we have worked through those transactions, they've all come down to cash flow. They've all come down to not only historical cash flows, but what is happening in current cash flows. The fact that these companies are profitable isn't in itself enough to persuade the banks to do the transactions. So I think part of it is understanding your own company's cash flow, and it goes much deeper than your income tax return or your financial statement. The credit crisis has hit us all. It's somewhat, you can't escape it. I went to the ATM the other day, and when I put my card in and pulled it out, it said insufficient funds. I wasn't sure if they were talking about me or the bank. And I think
which bank was it out there?
Yeah, what bank?
And I think companies are in those same situations where they're going to deal with banks and partners that they've dealt with, but these banks have found themselves in situations that are as uncomfortable as maybe the clients are. So I think understanding your cash flows and understanding really what drives your cash flows is critical today if we're going to secure financing.
And I'll add to that just a little bit. It's something that we probably as an industry didn't do a good enough job in the past was understanding what drives cash flows. And that's one of the reasons that at Wells Fargo, as well as some of our competitors, we have agriculture specialty groups that better understand some of the risks involved with agriculture. We all who operate in the industry understand the volatility that goes with cash flows, the volatility of commodity prices, of various inputs, the weather risk that is inherent in crop production. What's important is to take, from our perspective, what's happened in the past and be able to look to the future. And to do that, you've got to understand what the risks were. If the cash flow is okay, but it's based on record high prices that you're receiving for your product, that's one thing. If the cash flow is poor, but it's coming off a large loss from a hurricane, that's something else. So, as our economist, Dr. Swanson, said, the projections are going to be wrong. When we do a projection of cash flow, or we ask you for one, it's going to be wrong too. But it's the basis to start looking at scenarios, and that's what we have to understand.
In dealing, I do a lot of lending work, and dealing with loan officers, they commonly complain about the regulators and they're having their hands tied. How does the current regulatory environment affect financing?
That's one of my big gripes. I don't think you and I have done a deal together, but it sounds like I may have channeled some of my thoughts earlier. The reality of our regulatory environment, there's two pieces. One, there's new regulations, which really haven't hit the commercial lending side of banking, that hard. They've hit some other areas. What I run more into is taking the existing regulations that have been on the books for many years and reinterpreting them. And what that does, we all hear the politicians, they'll blame me because banks aren't lending enough money. And then the regulator that I deal with the most is the OCC. They're the ones that actually come in and look at our deals on a loan-by-loan level and tell us what they think, and tell us what we did wrong. And they're pulling the other way. Oh no, you're not. You're not going to make those loans anymore. And the reality of that is as these regulations have been reinterpreted, it makes everything more cumbersome. We talked the other day about being a relationship banker. As someone who knows you, knows your business, understands the risks of it, understands your strength in management, your balance sheet, your cash flows, all of that. If you come with a relatively small or routine loan request, as a banker who knows your relationship, I ought to be able to respond to that very quickly, if not right away. And that's still the goal we strive for. But as Commissioner Putnam talked about, parts of checking all the boxes as part of regulatory enforcement, in my world, there's a lot more boxes than there used to be. And the reality of that is it slows us down. I don't know that it's prevented us from doing some things we like to do, but the bigger impact is it slows us down. It requires us to ask more of you than we have in the past, collect more information, really prove what we already know. And that's been the struggle on our part, is how to be responsive to your needs, but at the same time, stay clear of our regulators. That's more of a challenge than ever.
I know I bought a house recently and took out a small mortgage, and it was unbelievable. All the questions that I had to answer. One of them was, where did the money in your account come from? Whereupon I responded, I have a job. and number two, they said, well, why has your income gone down since 2005? And I said, because unfortunately I'm a real estate lawyer. So I've seen some of the bureaucracy that the underwriters are having to go through, and it's because of past mistakes. I think
right, and it comes from, common sense can tell you to do one thing. Being a lender and knowing what we're doing is one thing. Pleasing the regulatory channel, it's an entirely separate track. And unfortunately, we have to do both.
We'll go back to the cash flow issue on the next question. If I improve profits, doesn't that improve cash flow?
In general, when you hear that comment, you would probably say, well, certainly it improves cash flow. But as the bankers are looking into people's statements of finances, we're in the information era, and they expect companies to have a lot better information. And so profits can be improved quite simply, believe it or not. If you've got deferred maintenance, if you just fire your maintenance department and say, we're not going to do any maintenance, that certainly would improve profits in the short run. You probably all had cost-cutting measures. And if you think about cutting costs, it's really a simple task. Didn't say easy, but it's simple. You get your ledger, you sort it big to small, and you start going down through the list and deciding what to cut. The hard part comes is, can you make those cuts? Well, companies have made those cuts as the economy has slowed down. But the question now is, well, what impact is that going to have on production? What impact is it going to have to defer all those maintenance costs? And banks are wise to that now, and they're saying, all right, what's behind this improved profits in this short run? They also might be saying, well, you improved profits, but did you liquidate assets? And liquidation of an asset certainly might make your statements look better in a year, but it may make it tougher. You're going to give up the cash flows, presumably, that asset generated in years to come. So the fact that you're improving profits is certainly moves in the right direction, but based on some of the financing I've done, that's not the check the box. Well, they have a profit trend that's moving up. They want to understand what's underneath that. And I think the importance is diving into, either as a business owner, as a manager, of a business, what's driving the business? As we do audits out in the marketplace, and my staff accountants come and say, yep, receivables are right, or fixed assets are right, or yes, here's the bottom line. And I ask them, well, how did they make their money? Where's their dollars going? It's interesting to understand who really knows the business and who we talk to in the business that can tell you which division, which SKU, which block, which grow, where are the profits coming from. You may have a profitable organization, but all the profits are coming from one division, and you got 3 other divisions that are leaking like a sieve. And I think it's important to really dive in and understand that. There's oftentimes I'll go sit down with a rancher and say, what's it cost you to raise a calf? Oh, it cost me $250, $350. Really great. What are you selling them for? Oh, we're getting $550 for them today. Wonderful. What's your calving rate? Oh, we're at 85% calf rate. So I quickly do the math. Then I go over and look at their general ledger, and the numbers they told me don't equate into the profits that are showing up on the statements. I go to a grove owner. What's it costing you an acre? Well, we're spending $1,500 an acre on our groves. Really? You're getting 500 boxes an acre? Wonderful. What kind of contract do you have? Oh, we got a floored contract at $175. You do the math and you say, well, these ought to be extremely profitable. You get to the ledger and they don't match up with that. So I think the importance of the cash flow is matching up your operational data with your financial data, and then working in conjunction with your bankers to help them understand the drivers of your business and understand what the volatility can do, and some sensitivity analysis that has happened. I've got a rancher client that sold 440 weight calves to deliver in November for $1.94. Well, if we build a pro forma on those statistics, that ranch is going to be extremely profitable. When we went to Farm Credit to talk about renewing the loan, they were smart enough to know that those statistics are not likely to continue long term. And so if they're going to give long-term financing, we've got to really show the cost side of it, of where the costs are, so they can understand as the market changes, is this still going to be a good loan? So I think there's no doubt I want to encourage you all to improve your bottom line and to generate profits, but I want to make sure that you're doing that in a way that's sustainable and not just short term.
Well, you mentioned what you do with cash flow, and what you have to look behind the scenes of how you got that cash flow, or why it might be artificial. With your lender hat on, Travis, how do you interpret cash flows? What are you guys looking at?
What we're looking at is trying to start with the set of numbers and turn that into a reality for the future. What do we think is going to happen in the future, upside and downside? And to do that, we've got to understand the story behind the numbers, and that's where a lot of our questions will come from if you sit down with us, is understanding the price points you're selling at, what you think about for the future, how you manage your input costs, if we see spikes in any given numbers, understanding what caused those. Something else that's always challenging us for us to manage is how much of an entity's cash flow is recurring. Sometimes it's very simple. If you sold a grove and money came in for that, obviously that's an impact in terms of, okay, it was a one-time cash infusion into the business. But then how do you treat that loss of revenue going forward? How do you pull that out? And I can't explain how many times we see someone saying, well, this was whether it was a fine from a regulatory agency or it was a spike in fertilizer costs, those kind of things. Oh, well, that's really a non-recurring expense. I mean, that's something that we had to go through. It was $130,000 last year. We're not going to see that again. But if you look over a 5 or 6 year track period, there's always something. So, it might move in what category it's in, but there's always something there. So understanding truly what's recurring and non-recurring is most important to us, because again, looking at the past data is only so much. We've got to be able to take that into the future, and the better you can explain to us and walk us through the reality behind those numbers, the easier our job becomes.
All right. It's time to grade the agricultural businesses. Do they do a better or worse job in handling their cash flow and managing debt than other industries? And you guys both deal with agriculture, non-agricultural, so be honest.
I'll start with that. you know, agriculture is the backbone of this country, above any other industry. I mean, I've been born and raised in it, so maybe I'm indoctrinated in it, but agricultural managers tend to be a little more conservative, and I think that has boded well. I think they understand the volatility of that industry, and you can have some great years and make a lot of money, and you can have some years where you lose some money. And that being said, I think they probably utilize debt better than some of the other organizations that we deal with or other industries. They're probably less, they would prefer to not have to use debt. And so I think they've done a pretty good job with that. Over the last few years, though, the difficulties come as those asset values have increased significantly year over year, and these younger generations want to access some of that capital, they've got themselves into some debt situations that they probably shouldn't have. But I would say, all in all, I think agriculture utilizes debt better than others. I think agriculture does not match up long-term debt and long-term assets, short-term debt and short-term assets, as well as some other industries. But I think overall, I would say they use debt better.
And I agree. It's in my experience, I've dealt on the agriculture side everything from very large, sophisticated operations where you have where you're dealing with a CFO and a very sophisticated financial group to signing loan documents on the hood of a truck. And from our perspective, one is not better than the other when it comes to cash flow. Some of our smaller growers are not. They're not very sophisticated financially, but they know enough to understand the volatility of their business and the need to be conservative. And then we see some of the more sophisticated operators that are much more comfortable with debt. They're much more comfortable negotiating terms with us. They're much more educated in that regard. But at the same time, they're farther out on that risk curve. And thinking back to the economics presentation earlier, as we look at the significant potential for more volatility in the future, as a whole, on our side and on the producers and the processors, we've got to do a better job of managing cash flow, specifically around managing those risks, because that's what we've seen in recent years is very long-standing, very good operations that have had too much debt. When they get hit by volatility, whether it's a significant drop in citrus prices or whether it's a fertilizer price spike, the more leverage you have. And I'm in the leverage business, it's what I provide, it's what I do, but the more you have, you get to a point where it is simply too much risk for an agriculture operation. And that's where, just beyond managing the cash flow, also managing your balance sheet and having a fallback position is so important.
We'll finish this session up with one last question. What's your recommendation to agricultural businesses on ways to improve cash flow?
I guess from my perspective, it probably starts with strategy. It's no different than any successful business. You've got to have a disciplined strategy in place. You're not going to improve cash flow by just cutting costs. I mean, that's certainly one aspect of it, but it goes much deeper than that. I think you've got to create a cost-conscious culture. And when I say that, I don't mean don't spend money. I don't say that in meaning we got to be the cheapest producer. We got to be the low-cost provider. I'm not against being that, but I think it's being smarter with the dollars you spend, making sure you're doing some kind of ROI analysis on the dollars you spend. What's the return going to be for what I spend, or what's the impact on production going to be when I cut costs? And so I think if you've got a management team that understands that these dollars have to provide a return, and they're making decisions on that, you can improve cash flow. I think the devil's in the detail. I think you've got to know your business down to the SKUs, if you run SKUs, down to the varieties, down to the blocks. Why did they invent sprayers now with eyes on them so it doesn't spray chemicals when you have blanks in your groves? I mean, to reduce cost. Same thing as when you're looking at your ledger and you're looking at your cost. You've got to be able to dissect that down and make sure that your spend matches with what goals you're trying to do. And I think you've got to understand your operating cycle. Agriculture has a unique operating cycle that's unlike manufacturers, retail sales, and so you've got to understand that and make sure that your vendor terms, your loan terms, and some of your payment terms match with your cash flow as they come in cyclical. So I think it can be done. I don't think it's something that you can just say we're going to improve cash flow, but you can certainly make a strategic effort and improve cash flow.
And what I would add to that is again, look at ways to take some of that volatility out and seriously consider those. You know, I've never told, you know, any one customer, you know, you should take that long-term contract or you shouldn't. I mean, that's not my role. But we do try to help advise there and look at how that impacts taking volatility out of your business. You know, a long-term contract, if you're going to, there's a cost to that. You lose some upside. You may lose on the average, but there's also a benefit to it. There's a benefit in terms of taking that volatility out, not having those really poor years where you get into a cash flow crunch. Eliminating some of that risk is like an insurance contract. There's a cost, but there's also a value. And look at those not just on the revenue side of your business, but also on the cost side of your business. If you're locking in your prices but not your input costs, you can find yourself doing more harm than good. But look at ways not just to take the overall level of cash flow up and reduce expenses, but also to find a way to add a little stability wherever you can. That's going to take risk out of your business. That'll make you more profitable in the long term.
All right. Well, Clay, Travis, thank you for joining me today. That's be the end of our session, although I'm sure these guys will be glad to stick around and answer any questions after Michael gives us some closing remarks. Thank you.
Well, before we have closing remarks, do we have any questions for our panel here?
I think you've worn them out.
Travis has got a checkbook out up here. So.
Now, I consider myself an old school banker. I don't have a checkbook. I got a trunk full of cash.
There you go.
So let's do some
Even
business.
better. And it's a stagecoach full of cash.
We've got one question over here.
I was just wondering how E-Verify was going to affect the ability for farmers to get financing.
If you were here for the labor law session earlier this morning, you would hope.
I'll tell you, it hasn't helped the cash flow. I've got a roofing client here in town, employs about 500 people. They signed up for E-Verify, and they had about 100 employees show up the next day. And so I know that's not agriculture, but it's going to have a significant impact on the businesses y'all are in.
From our perspective, I'm no expert on labor law, but looking at the overall picture, we understand as much as anyone how broken the current system is, and in going to E-Verify without addressing the other side of the issues, the impact that can have on agriculture. The reality of our viewpoint on it is, we're looking for folks that really do the best they can within the current system is our ideal. What will come down the pipe, I can't predict that. The risk obviously is you can't access labor. You can't run your business. If you can't run your business, it will impact your ability to get financing. So we're as hopeful as anybody and supportive as anybody is fixing the real issue rather than just going to E-Verify as the first step. But I don't have any predictions for how that's going to play out.
I think it's new economic incentive for mechanical harvesters. Any other questions? Yes.
Piggyback on that, do you all take that into account when you're looking at how much you're lending out to agriculture businesses? Those type of legislative actions are what will impact our industry and ability to be profitable in the long run.
Right now, we're not taking a position on what the regulatory environment will be and basing any decisions on that. When we talk to, say, an individual producer, in looking at, we do ask about labor practices. How do you obtain your workers? How do you obtain your seasonal crew? Who do you go through to get that and understand? And we do, on the margins, factor that in to our decisions. I have had folks tell me, I go through Jose. He brings a crew in every year. I pay him cash, and what he does with his folks is none of my business. That's obviously not a best practice, But we do see it out there, but it does add risk from our perspective. And of course, anything that adds risk is going to impact us. Again, we're looking for folks who are doing the best they can to comply under the current reality, but looking towards the future and trying to base decisions on what we think the future is going to be in the regulatory environment. We haven't gone that far.
Anyone else? I want to thank our panel. Thank you very much for participating. Appreciate it.